Hello, participants. Good morning and welcome to this yet another event of the WIRC on valuation under FEMA. One of the very key topics, one of the very hot topics, and something that can really have a huge impact on most of the deals. That is the valuation. The way it can go, it can really make or break the deal. Today we've got a wonderful faculty, CA Parag Kulkarni, and let me at the outset thank him to accept our invitation at such a short notice and come and grace the occasion for today's session. 20th February Sunday, a fine morning. Welcome one and all. Let's start with put your hands on your heart. So for our ICI motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Right. Thank you, everyone. Today we've got the chairman of WIRC, CA Manish Gadia, RCM elect, the newly elected RCM, CA Ketan Sayya, along with our faculty, CA Parag Kulkarni, and I, Riprit Kabra, the secretary of WIRC of ICI. Friends, before we could begin our session, all of us are in absolute shock and a moment of that we never thought we would face so early in our lives. A very humble and a very dynamic, a leader in true sense and spirit, CA Sunilji Patodia, a Central Council member, past chairman of WRC, left for the heavenly abode. His sudden demise has left all of us heartbroken. And in his memory, in his respect, the first lecture that we are doing, we would request all of you, let's maintain a 30-second of silence for his soul to attain moksha. Om Shanti. People who must have joined in the middle, people who must have joined, who would have seen our screens and utmost silence, would be wondering, why is this silence? Or people who are, this silence sometimes becomes so disturbing. I imagine the silence, the absence of action, because Sunilji is no more with us, would be so disturbing and would have such a huge impact. Silence, therefore, definitely makes sense to each one of us. On this very powerful note, may I now request the chairman of WRC, Manish Gadia, to please address the gathering. Over to you, Manish Bhai.
Good morning and happy Sunday to all of you. First of all, I thank Parag Kulkarni from Pune to accept our invitation at less than a 24-hour notice to address this typical topic, that is valuation under FEMA. which is, as Arpit said, is very, very important topic, and we should understand that what we are going to cover today. And really, as Arpit said, we all are missing Sunilji Patodia, who was past chairman of WIRC and currently Central Council member. A humble person, always available for any work of the institute at 24/7. He was for the available for institute work. I will not take much time. Over to you, Ketan.
Thank you, Manish Bhai. May I now request the dynamic Regional Council member Ketan Sayya to please introduce our faculty for today so that we could begin with the proceedings.
Thank you, Arpit, Secretary of WIRC, Chairman Manish Gadia, and the faculty for the program. Good morning to all of you. CA Parag Kulkarni. He is the first and only Indian to be CA from 4 countries. He has done his CA from India, CPA from USA, CA from England and Wales, and he has received the high honors from the New York Stern Business School for the advanced valuation from the august hands of valuation guru, Professor Aswath Damodaran. He has received the honorary degree of BFP from Chartered Accountant Institute of England and Wales. He is IBBI registered valuer. He holds diploma in IFR from ACCA and IFRS certificate from ICAI. He is a member of Board of Studies of prestigious College of Pune, that is SP College. He has authored the book on IFRS, for which forward has been extended by the previous Central Council member, previous Central Minister CA Suresh Prabhuji. He is a founder of Insta Lab. He is presently working into the valuation, corporate finance, and IFRS. I'm wondering, so many degree at the to the credit of Parag at the young age. And as rightly told by Chairman and Secretary, Parag, we are thankful to you for having accepted our invitation, and request all of you to carry it with the loud round of applause to welcome the Parag. Over to you, Arpit.
Thank you, Ketan Bhai. Believe me, when someone talks about valuation, and if we don't pay respect to Shri Aswath Damodaran sir, I think that would be a crime. And Parag Bhai, I'm really happy in your CV when we mention his name. I think valuation or A to Z of valuation gets covered there. And I'm sure with Damodaran sir's guidance with you, I think you're gonna do wonders for us in valuation also. So over to you, Parag Bhai.
Thank you so much, Chairman Sir Manish ji, Secretary Sir Arpit ji, and newly elected Regional Council Member Ketan Sir. First of all, thank you so much for considering me, and it's always pleasure to participate and contribute at the institute, specifically at WRC level. You said that you would like to thank for accepting this invitation in less than 24 hours when this seminar is due. I think the beauty lies in the eyes of beholder. So you are worthy of considering me of addressing this August gathering. So thank you so much once again. Without further ado, I would like to jump into the technical content of today's discussion, that is valuation under FEMA. Before I do so, if anyone can just give me a confirmation, my voice is audible, my screen is legible, and when I change the screen, that change of screen happens and it's visible to everyone. Can anyone please confirm that?
Yeah, Parag Bhai, it's perfect.
Perfect. So we have a couple of hours before we conclude, let's say around 1 o'clock or so, and maybe excluding last 15-20 minutes for any discussion or deliberation. Let's say we have approximately 1.5 hours for the discussion. I would like to segregate this 1.5 hours into 5 these areas: background, investments in India, and investments from India. That is, when I'm speaking about investment in India, obviously I mean foreign investors investing in India, that is foreign direct investments. When I speak about investments from India, obviously I mean Indians investing in territories outside India, that is overseas direct investment. And then finally, I don't want to restrict myself into the rules and regulations which are issued by FEMA and RBI, because to me, without discussing a case study and the nuances of calculation, I believe this session will not be complete. So last but not the least, I would like to deep down into a case study. Uh, for this session, I have once again, considered the celebrated case study of Aramco that we have been presenting from the VSB and different seminars. So we have got a real good feedback for the case study that we have developed on valuation of Aramco, and that's why I've chosen the same case study to be discussed in last, let's say, 30 minutes to 45 minutes, or maybe little for a little longer time. With this, let's first go into the next concept of investments, that is foreign direct investments and overseas direct investment. This slide is prepared primarily to give you overview of the scope that we are covering. So though we are speaking about the Foreign Exchange Management Act, ultimately FEMA has given power to RBI in order to regulate the foreign direct investments and overseas direct investments. And RBI is doing so rightfully by issuing notifications and circulars. So there are two circulars which are very important to us. One that was issued originally in year 2017-18 and has been updated as of 8 March 2019, which is the latest update. Subsequent to that, the amendment has not taken any place, and this is with respect to the foreign direct investment. So from the scope perspective of all of you performing your own practice, I would say you will work either with those people who are investing in India or with those people who have money in India and they want to invest outside India. If you're working and dealing with those organizations who are bringing that money inside India, for example, Tesla is opening up factory in India, obviously it will fall under foreign direct investment. Example, Tata Group acquiring Land Rover in the European nation, it will fall under overseas direct investment, right? So in that sense, at an overview level, I would like to first identify what are our pain points. So when we practice into valuation, the pain points are, if someone is coming in India and investing, what is its compliance? What kind of valuations are necessary? From a macro level perspective, we would say that Indian would not like to sell off their assets, their resources at a price below fair value. And in that sense, RBI or any authority should take care of those valuation principles or pricing guidelines, thereby ensuring that the price that is received inside the country, that is money that is received inside the country, for allowing foreigner, for allowing non-resident, for allowing all those entities outside India to utilize resources in India at a fair price. So if you are dealing with these clients, then you must follow the master direction number 11/2017-18 that I've quoted in the mid of this slide. On the other hand side, if you are dealing with those clients who are doing extremely good in India and now they aspire to become a multinational organization, for example, they can create their subsidiary in, let's say, UAE or East Asian economies or an African continent, and why not in USA or in Europe. If that's the case, obviously you are looking at overseas direct investment. I was fortunate enough to work around ODI in year 2019-20, specifically when one of the Indian entrepreneurs acquired majority stake, rather the controlling ownership in one of the Italian company. So whatever limited exposure that I have on practically working on such multinational M&A and thereby getting exposed to the overseas direct investment rules, I would like to share that incidences as well. So what we will do is, with this, we will first discuss in detail the rules and regulation which are applicable if you are bringing investment in India, that is in case of foreign direct investment. Then we will discuss in detail the rules and regulations applicable if you are investing outside India, that is when you are doing overseas direct investment. In each of these two key segments, we have almost total minimum 15 number of critical pointers to discuss from a rule perspective. Once we complete that, then it's important for us to go and discuss a real life case study where we will look to see, okay, when you're saying valuation is to be done, what is the right way of doing valuation? How the number crunching should happen, how the story writing should happen, how the way we have to utilize the databases, from where to source the data, and how to fit in or prepare those financials and the valuations or prospective financial statements that are in line with the rules and regulations in India and also in line with the valuation guidelines which are applicable in the international scenario. So now let's first discuss investments in India that are foreign direct investments. I'll take substantial amount of time on this slide, maybe minimum 10 minutes or so. As you can see, I believe that there are 6 critical areas that I must discuss. Let me first start with my introduction. The Foreign Exchange Management Act 1999 empowers Reserve Bank of India. Just a second. I hope still legible now. Right. So the Foreign Exchange Management Act 1999 empowers the Reserve Bank to frame regulations to prohibit, restrict, or regulate transfer or issue of any security by person resident outside India. Now, these regulations are notified as Foreign Exchange Management Transfer or Issue of Security by Person Resident Outside India Regulations 2017 under notification issue. So you can search for a notification. We call it the FEMA 20R. The notification was issued on 7th November 2017. That's a critical notification, and I strongly recommend you to download that notification and keep it handy as and when it is required at your end. An investment made by a person resident outside India in accordance with FEMA or the rules or the regulation FEMA, thereunder, and held on the commencement of FEMA 20R shall be deemed to have been made in accordance with FEMA, which means there is a grandfather transaction. So let's not go into 2017 previous transactions, but if you believe that certain investments were received in India before 2017, and if today you are wondering whether those investments were in compliance with FEMA regulations or the 20R compliance, then they have been grandfathered, which means they shall be deemed to have been made in accordance with FEMA 20R and shall accordingly be governed by FEMA 20R. A person resident outside India may hold, own. Now, hold means you can hold in the trustship or you can hold in name of some other person. So hold, own, transfer, or invest in a security in India if such security was acquired, held, or owned by such person when he was resident in India or inherited from a person who was resident in India, and such investment will be held by such person on a non-repatriable basis. So we'll go into the discussion of repatriation and non-repatriation, but I believe that's a common English word and you all know the meaning of repatriation. The meaning of repatriation is when I say I'm holding an investment on a repatriation basis, it means I invest in a particular company in that country and I have right to sell it off and get back my money going forward. So I can get back my money, that is a repatriation of my money is possible. I would like to make note of certain key definitions. Minimum number of those key items of which the definition you must be aware of. The first key definition I believe you should be knowing of is of capital instruments. So what are capital instruments? Capital instruments are equity shares, debentures, preference shares, and share warrants issued by Indian company. And the details of what shall constitute capital instruments can be once again looked into if you refer to the master direction. So when you look at that master direction specifically for FDI, of which number I have already given, once you go to para number 4, you will get all those details. You must also know the meaning of convertible note. Convertible note is an instrument issued by a startup company evidencing receipt of money initially as a debt, which is payable at the option of the holder or which is convertible into such number of equity shares of such startup company within a period not exceeding 5 years from the date of issue of convertible note upon occurrence of specified events as per the other terms and conditions which can be agreed between the shareholders or between the parties. So one of the takeaway that we have is if you are a startup company, you can issue convertible instrument to a foreign investor. However, if you are issuing such convertible instruments, that conversion period should not be exceeding beyond 5 years, or the relinquishment of that particular date either by way of payment or by way of conversion into equity share should not happen beyond a period of 5 years. Why I wanted you to bring this particular factor in the discussion: when you do the valuation calculations, these convertible instruments for the valuation might not be always treated as a debt instrument. Maybe for a taxation purpose they are treated as a debt instrument, but when it comes to convertible instrument from the valuation perspective, question is it a value of equity or is it a value of a debt? Because if it's a value of a debt, then debt can be identified with explicit principal cash flows and explicit interest cash flows. Consequently, valuation of debt instrument is nothing but the valuation of cash flows on account of principal and interest. However, the moment you bring in the convertibility, that is a derivative embedded onto the host contract of a on a plain note, then that derivative may convert that security into an equity instrument. And obviously then we need to fall back onto IS 32 in Indian parlance or Ind AS 32 in Indian parlance. So under Ind AS 32, you need to go back and refer to para 8, which defines what is a financial liability, what is a financial asset, and then ultimately it says that equity is basically the residual interest in the company. So you at the back end, when you're documenting your valuation on a convertible note, the first judgment that you need to pass is it a debt instrument or is it an equity instrument for the valuation purpose? And obviously we want to bring and ensure the consistency between accounting and the valuation that you're doing. So something that you are classifying as a debt instrument for accounting logically should reflect that kind of cash flows when you are considering it for the valuation. On the same front, if you are classifying a particular convertible instrument as an equity under Ind AS 32, then you cannot follow the principles of debt valuation to value an instrument which has been already classified as an equity. Rather, in that case, you need to perform an equity valuation of an entity, and then some portion of that equity has to be carved out to be attributable to this particular convertible equity instrument. Having said that, let's move ahead. Next definition which I would like you to be to note is the foreign direct investment. Foreign direct investment is an investment through capital instruments by a person resident outside India in an unlisted company or in 10% or more of the post-issue paid up capital on a fully diluted basis of a listed Indian company. And then there is another word, foreign investment. So please note that foreign direct investment and foreign investment are two independent words. They are not synonymous. I have seen many valuers writing in their report foreign investments and foreign direct investments exchangeably. So don't do that. They both have been separately defined in the rules, and that's why they are not interchangeable. They need to be meant differently and they need to be mentioned in a context. So foreign investment is any investment made by a person resident outside India on a repatriable basis in capital instrument of an Indian company or the capital of a LLP. So in that sense, you can say foreign investment is a larger set and foreign direct investment is a subset of a foreign investment. See, an Indian company is permitted to receive foreign investment by issuing capital instrument to the investor. Now that capital instrument could be equity share, could be debentures, could be preference shares or warrants issued by the Indian company. Next point I would like you to understand is of share warrants. So share warrants were not previously considered as a capital instrument. Rather, there was an amendment came on 8 July 2014, and subsequent to 8 July 2014, now share warrants are considered as a capital instrument. Typically under share warrants are what? They're nothing but an option for you to get the shares at a future date. So when you issue share warrants, they may be issued by receiving nothing. That is, you just issue share warrants, that's it, and you get nothing out of it. Or you can issue them for a particular price. But considering the Indian scenario, we are seeing share warrants are attachable or detachable share warrants that have been given without any considerations. So share warrants are definitely now considered as capital instruments, and that's why they also fall within the ambit of these regulations. Now, why I want to bring out a concept of share warrant in today's discussion? Because these regulations may not similarly apply to those shares which are issued as bonus or those shares which are issued as right shares, as they do apply to shares which are issued as conversion of warrants or to warrant itself. So there is a difference when you are complying with bonus shares to investor outside India than compliance with respect to warrants to investor outside India. Last but not the least, you must also know that capital instruments cover debentures, and debentures are fully, compulsorily, and mandatorily convertible debentures. Now, the next point which I would like to highlight is then what kind of transactions are basically covered under these policies. The first level of transaction that is covered under these policies are the first level of transaction is the transfer of capital instrument of an Indian company by or to a person resident outside India. Now, when we look at that such kind of transfer where the capital instrument is given to a person resident outside India, or it has been transferred by a person resident outside India, then again, we can focus on minimum two different level of transfers, and out of which the two critical transfers are: one is transfer from a person resident outside India by way of sale or gift to any person resident outside India. So let's take a scenario. In a scenario, Mr. X is owning equity shares of Peace India Limited, and Mr. X is non-resident, which means he's a resident outside India. Let's assume he's in USA. And then he gifts shares of Peace India Limited to his daughter, who is also non-resident, that is person resident outside India, and she's also in USA. Now, a person is not here in India. A person transferring share is also not in India. A person receiving share is also not in India. But both of these persons are basically exchanging an asset of an Indian company. And then such transfers are also governed under the FEMA and RBI guidance. So transfer from a person resident outside India by way of sell or gift to any person resident outside India. One of the classic case that we have discussed is of Hutch Vodafone case, where the ownership was in Hong Kong and the transfer of ownership happened in the Hong Kong, that is outside India, but of an asset in India, that is of equity share of a company in India. Now, whether such transfer is governed by FEMA, answer is yes. It is definitely covered under FEMA. A person resident outside India who has invested in capital instrument of Indian company or units in accordance with FEMA 20R can transfer these capital instruments or units subject to terms and conditions. And what are these terms and conditions? So a person resident outside India, not being a non-resident Indian or overseas citizen of India or overseas corporate body, may transfer by way of sale or gift the capital instrument of an Indian company or units held by that person to any person resident outside India. And it shall also include transfer of capital instrument of an Indian company pursuant to merger, demerger, amalgamation of entities or companies incorporated or registered outside India. Which means if couple of companies are getting merged here and that's why the share exchange happens, then it also extends to its subsidiaries or joint ventures or all the investments basically which may be in India or which may be outside India. And by the way, when you do so, prior government approval is required to be obtained for any transfer in case the company is engaged in a sector for which the government pre-approval is necessary. So the automatic route and the approval route are two routes, obviously, which I'll be discussing subsequently, but that are primarily for the investment, that is overseas direct investment, and also in some of the cases for foreign direct investment. So the approval route or automatic route gets classified on the basis of the industry in which you are working. So it's a twofold regulation that you need to take care of. One is if non-resident to non-resident transfer is happening, that is perfectly fine. But if that transfer is happening of a company for which a specific government approval is required, then obviously you need to also seek those kind of government approvals. For obvious reasons, that if there is a change in the ownership, then government should be notified about that particular change, that who is owning, and there are certain rules which says that residents of certain countries, okay, cannot own shares on a particular sector. So for example, now nationals of Pakistan and Bangladesh cannot own shares in some of the Indian companies and then in some of the specific sectors, right? So in that sense it becomes important to analyze compliances on a twofold scenarios. One is by way of looking at whether that transfer is within the rule book of RBI guidelines, and then whether the transfer is of an asset for which a government approval is necessary. Now the next point is transfer by NRI or OCI by way of gift or sale to any person resident outside India. So if you are Indian but you are non-resident in India, or if OCI, okay, holding capital instruments of Indian company or units on a repatriation basis, yes, you can transfer these instruments in the same way by way of sale or gift to any person resident outside India. So obviously both conditions that we discussed for the previous scenario, that is for a person who is a resident outside India, okay, so there is a difference between when I say technically a person resident outside India and when I quote non-Indian resident or non-resident NRI. So person resident outside India is not at all Indian, okay, he is not at all Indian, he is altogether third party who is residing outside India. When I speak about NRI, primarily I mean they are Indians, but they are not residing in India. They are non-resident but Indians. Okay, NRIs. So try to also identify these technical nuances when you're identifying the compliance requirements. Obviously, compliance requirement for person resident outside India and non-resident Indians, they are one and the same, because they allow you to transfer the shares on a gift basis or on a sale basis, provided that if you are selling the shares of companies for which specific prior government approval is necessary, you are taking it on record. Okay, now let's move ahead. Last point on this slide: transfer by a person resident outside India of capital instrument containing an optionality clause. A lot of VCs, when they do investments in Indian startup, these investments are flowing from Singapore, these investments are flowing from Mauritius, these investments are typically flowing from some of the tax havens. And for these instruments, this particular point is very, very important. So if you're dealing with a startup company which has recently received an investment from uh, a person resident outside India, let's say from a VC incorporated in Singapore, okay, and then there is an exit clause, okay, when you received an investment, you also agreed for an exit clause, okay. If that's the case, then obviously this point becomes very, very important to you. So let's understand what is this point. Now this point is about a person resident outside India, which is in our example, let's say a venture capitalist incorporated in Singapore, holding capital instrument of Indian company, let's say Indian company is Peace India Limited, and the instrument is preferred stock. So let me try to revise the example. So let's say Singapore VC Limited invest in Peace India Limited in a preferred stock containing what? Now that particular agreement contains an optionality clause in accordance with FEMA 20R, and exercising the option or right can exit without any assured return, subject to obviously the pricing guidelines. Then obviously such investment is okay. So if there is a guarantee of return, if there is an assurance of return, then there is a challenge. Maybe such instruments cannot be issued to foreign foreign individuals. You need to follow the pricing guidelines, and you need to ensure that there is no assured or guaranteed return on such kind of capital instruments. Obviously if the instrument is not the capital instrument, then forget about it. But if the instrument is capital instrument, then you need to look at the compliances with FEMA 20R rules. And then what you need to do is you need to have a minimum lock-in period of 1 year or a minimum lock-in period as given under FEMA 20R guidelines, whichever is higher. Now obviously these guidelines may undergo a change on year-to-year basis, and it may also undergo a change by making these guidelines specific to certain types of instruments. So as we evolve, as we progress, as nations needs differ, as cash flows from foreign nationals differ over the period, these rules and regulations may change going forward. So obviously now the next point that we must discuss on the next slide is, just a second. I hope still my slides are visible to you. Can someone confirm?
Yes,
Are
sir.
we
Yes,
on,
sir.
can you see my slide on FDI pricing?
Yes, sir. FDI.
I assume that you are able to see my screen on FDI pricing, because I can't see the chat box and I can't see any one of you. I can't see your messages as well. So I assume, and I'll continue our discussion. Okay. So we have discussed in which scenarios these FDI guidelines are applicable. Now is the time to discuss these 9 areas when the pricing points become important from the valuation perspective. So what are these 10 points? Let's read them first slowly and then let's try to discuss them one by one. First is capital instruments issued by a company to a person resident outside India. Second, capital instruments transferred by a person resident in India to a person resident outside India. Third, capital instruments transferred by a person resident outside India to a person resident in India. So the second case was from Indian to person who is abroad. Third case is from a person who is abroad to a person in India. Fourth case is swap of capital instrument. That is not exactly a barter exchange, but like a barter exchange. Instead of exchanging in barter with goods and services, you swap the instrument for instrument. Like you say that I am giving you shares of Indian company, you give me shares of your foreign company, and likewise. The fifth point is subscription to memorandum of association, which means that the incorporation itself, you are basically becoming the owner of the company, and it's obviously possible. Uh, uh, some of the new foreign nationals, take the example of Tesla, who want to create new subsidiary in India. Obviously, they might fall into point number 5, that is subscription to memorandum of association. That is, at the incorporation itself, the shares are issued. 6, how to work around in case of partly paid shares. 7, share warrants. 8, investment in LLP. 9, transfer of capital contribution or profit or share of an LLP. And finally, I discuss on the non-applicability in case of the transfer of non-repatriation basis. So let's discuss these points one by one. First, capital instruments issued by a company to a person resident outside India. The price of capital instrument of an Indian company is issued by it to a person resident outside India should not be less than something. Okay. So again, while I was reading the law, I was, quite surprised to see the particular way of wording the RBI has drafted, and it ends with the word should not be less than. And why these particular words sound so important to me. So I tried comparing the pricing guidelines for FDI and ODI. So when I look at it from the FDI perspective, that is foreign direct investment, RBI is saying that you have to get the money, which is of fair value. So when they wrote a definition or when they wrote a pricing guidelines, they said that minimum we should get this. So while they were defining these rules in para 8 of those guidelines of FDI guidelines, they have used the word saying that the amount that you have to receive or the price that you must receive should not be less than 1, 2, 3, 4. Okay. Now similar guidance is not given for ODI, because for ODI obviously will be paying out of India. So if you are getting something cheap, RBI says no problem. We don't want to write something you should pay not less than 1, 2, 3, 4. That's not how it has worded it. So it's quite it's a very wise way of handling foreign diplomacy, along with inviting these foreign direct investments in India. So while creating the law and drafting those lines, they have ensured that if money has to come in India, that money should come at a price which is definitely not less than a fair value. But if money is going out of India, ensure that it should not be more than a particular price, right? Because if you are paying more, then you are unnecessarily using Indian resources to get a value which is lower than the value of the resource that you are transferring. So For ODI guidelines, the way of defining pricing guidance is different, and it is not the mirror image of what we see as the wording or the drafting of FDI guidelines or the pricing mechanism under FDI guidelines. So what it says for the FDI pricing mechanism, it says that the amount that you are receiving in India, that is the price of capital instrument of an Indian company issued by it to a person resident outside India, should not be less than the price worked out in accordance with the relevant SEBI guidelines in case of a listed Indian company, or in case of a company going through delisting process as per the SEBI delisting of equity shares regulations 2009. So in case of listing company, we are saying that whatever rules that we are applying for listing and the way you carry the valuations for listing, at least that particular minimum value that you should get. So if Indian is paying, let's say, 100 rupees per share, then foreign national should also pay minimum 100 rupees per share. That's the logic behind it. Second is obviously for unlisted entities. So the valuation of capital instruments does not, the valuation of capital instruments done as per any internationally accepted pricing methodology for valuation on arm's length basis, duly certified by chartered accountant or SEBI registered merchant banker or practicing cost accountant in case of unlisted Indian company. So for listed company, if you're following SEBI guidance, perfectly fine. For unlisted companies, you have to follow internationally accepted pricing methodology, which basically means you need to follow IVAC, that is International Valuation Standard Committee's valuation standards, or you can also follow ICI valuation standards because they are also international standards, in the sense that rather few months back I myself made presentation to SAFA countries, which included Pakistan, Bangladesh, Afghanistan, Sri Lanka, Myanmar, and Maldives. And all of these countries, when we were discussing at the VSB, they showcased interest in adopting ICI's valuation standard. So this is such a wonderful news that ICI creates standards which are domestically accepted and robustly followed by its members, but it has also seen a day of light where it has a validity in some of the foreign nations as well, our neighbors. And irrespective of the political or let's say strategic partnership that we have or we don't have these nations, I am very glad that ICI has its footprints across the Asian continent, and that's very wonderful. So I can take a liberty of saying that if at all, let's say you are doing an investments in Nepal, or you are doing certain investments in Bhutan or in Myanmar or in Sri Lanka, it's not always that you do invest in USA or in Zambia or in Switzerland, right? You can obviously do investments in your neighboring countries. I mean, your consultants and your entrepreneurs with whom you are working obviously might be doing such kind of investments. And in that case, even if you follow ICI valuation standard, I personally believe that you are complying with the guidance under FDI, because they are also very well accepted at the international level. And if you follow ICI valuation standard, trust me, 99% you are also in compliance with internationally accepted, that is IVAC valuation standard, right? So if you are in line with the ICI valuation standard, perfectly fine. You are also falling in line with the IVAC, except for the fact that maybe you need to be more articulative in bringing the rationale of each assumption that you are making and the conclusions that you are drawing, along with the detailed sensitivity analysis. In one of the recent notifications, we are seeing even the registered valuers are allowed to do such valuations. So if let's say someone is investing in LLP, you as a registered valuer are also allowed to do these valuations, and then that particular valuation report can also fulfill these compliances. Let me discuss on next point, that is capital instrument transferred by a person resident in India to a person resident outside India. So imagine that Mr. India, a person in India, transfer shares of Peace India Limited, that is Indian company, to Mr. USA. That's the case that we are discussing. Let me repeat, we are discussing a case where Mr. India, who owns shares of Peace India Limited, transfers shares to Mr. USA. Or let's take a scenario. You build up a startup. Your startup is in defense sector, or oh no, I think I should not speak on defense because you have prohibitions in foreign investment in defense. Let's say you are working in, let's say, artificial intelligence or machine learning, or some of the high-end technologies like blockchain, etc. And then one of the US based bigger conglomerate comes to you, for example Google comes to you and says that we want to acquire your company. It is the case of this particular example that we are discussing, because you are Indian, you are owning shares of Indian company, and now foreign national, that is a person resident outside India, is acquiring the shares. So the price of capital instrument of Indian company transferred by a person resident in India to a person resident outside India should not be less than. Again, the word comes is that should not be less than what? The price worked out in accordance with SEBI guidelines if the company is listed, or the price at which the preferential allotment of shares can be made under SEBI guidelines is applicable in case of a listed company, or if the company is under delisting process, you have to apply those guidelines. And then finally, it says that valuation of capital instrument done as per the internationally accepted pricing methodology for valuation on arm's length basis, duly certified by chartered accountant, SEBI registered merchant banker, or a practicing cost accountant in case of unlisted company. And let me reiterate that now, and with the new notification, even the registered valuers can go ahead and then perform these valuations. I'll tell the issue is that in most of the other seminars where participants, attained valuation under FEMA, they came to me and say that, Parag, unfortunately, we discussed on the rules, but we have not discussed on how to carry the valuation. So I want to fulfill that limited gap, and I intend to do so by inclusion of that case study. So maybe for next 15 minutes or so, I will still continue my discussion on the rules, where we will identify exactly in which scenarios the valuation is necessary and who has right to perform valuation. I would also like to put in extensive time in showcasing you a case study where we discuss exactly how the valuation has happened. Okay, let's move ahead now and let's discuss on capital instruments now, which are transferred by a person resident outside India to a person resident in India. A case of, let's say, Tata Group entity, where they acquired the Land Rover in European Union, right, in the Britain. So, or maybe another case, you are growing Indian company, you are doing extremely great. Let's say you are now into gamification, you are into metaverse, etc. And one of your friend who did his MS from one of the US based university, has built a wonderful startup, and he is doing something, and sitting coming out of those Ivy League schools and having the peer and network, and also good resource in USA, he was able to build up something that you intend to have in order to supplement your existing work. Let's say you are a tech company, and in the education technology you want to bring a metaverse in order to create a more engaging experience. Now you are a cash rich company, because let's say you are Byju's of India. Okay, now what will you do? You would say it's a strategic acquisition that I can make. I can go out and I can buy out the company in US. You would pay handsome fee to him. Maybe you would say that I would like to acquire completely, and then you will work for me for next 3 years for the assumed compensation of whatever X dollar. Now that's case what we are discussing, where you are going out and acquiring companies across the nations. Or think about those manufacturing entrepreneurs like Vedanta Group, who has made heavy investments into mining companies in Australia. Or some of the very well-known Gujarati families have made extensive investments from their Indian arms to mining companies in Democratic Republic of Congo or in some of the African countries. So, or maybe you are that company, maybe a chartered accountant company or management consultancy company, who is now opening its into UAE, maybe by way of going or engaging yourself in the Dubai Expo or like that. So we are discussing your scenario where shares of company in another country are acquired by a person resident in India. How should you do the valuation? Again, the guidelines remain same. Okay, for a listed entity outside India, that valuation should happen with the listed guidance as per se. okay, or if the company is in the delisting process outside India, the valuation of that company should happen as per the delisting guidelines as per India. And if the company is unlisted, which it would be in most of the scenarios, in that case, what you must do is you need to appoint either a merchant banker or a chartered accountant or a cost accountant or registered valuer in order to perform these valuations and take on record the valuation report. And that uh, amount that you are going to get, okay, because the capital instruments are transferred by person resident outside India to person resident in India, okay, in that case we are saying that the valuation should happen by using those international benchmarks and by using the IVSC guidance. Similarly, the swap of capital instrument. Now, if you are not exchanging the cash, but if you are swapping the instruments, irrespective of the amount, the valuation will have to be made by a merchant banker registered with SEBI or an investment banker outside India registered with the appropriate regulatory authority in the host country. So here, chartered accountants cannot perform the valuation, only merchant bankers can do so. When it comes to the swap of capital instruments, please note the fact that chartered accountants cannot perform the valuation, only merchant bankers can perform these valuations. However, when shares in Indian company are issued to a person resident outside India, then such investment shall be made at a face value subject to entry route and sectoral caps. So your idea could be great. For example, if Tesla says that, I'm coming up in India and it's a huge market, does it mean that you will follow DCF method on the basis of the idea and Tesla has to issue shares? I mean, Tesla India will issue its own shares to Tesla USA, Tesla Inc. at a premium? No. When you are uh, incorporating a company and you are getting shares as a part of your entry through memorandum of association through MOA, obviously the shares will be issued at face value, and that is very well acceptable under FEMA. Now, the partly paid shares, the pricing of partly paid shares shall be determined upfront. So it's nothing but the total pricing of the shares on a fully paid basis, and then you try to prorate it, and that's how you calculate the partly paid valuation. So the valuation of partly paid shares. But again, that valuation should be in line with the international valuation guidance or as per the CB or etc. For share warrants, the pricing and the price conversion formula shall be determined upfront. So you can't say that one warrant will be converted into 3 shares, or one warrant will be converted into 4 shares, or you can't say that one warrant can be converted at 5 shares as that will be determined at the end of the 3 years. No, you have to define it will be converted either at one warrant is equal to 3 shares, or you can say one warrant is equal to 4 shares, or one warrant is equal to 1 share. So you need to have a defined conversion formula. You need to have a defined pricing upfront when you are issuing the warrants to persons which are residing outside India. And finally, in the investment in LLP, either by way of capital contribution or by way of acquisition or transfer of profit shares, should not be less than the fair price worked out as any valuation norm which is internationally accepted or adopted as per the market practice. So for LLP, please note that for LLP, you have no liberty to issue shares at face value because there is no face value. For limited liability partnership, it's a partnership interest and not a face value of an equity share, right? So in that case, because you don't have a face value, what you have is only partnership interest, and that partnership interest must be fair value. So if you are investing in Indian LLP, you need to bring in money which is a fair value. You can't fool Indian government by way of bringing less money in India and investing in, let's say, artificial intelligence or ML or one of the top-notch software company, and then ultimately repatriating the entire profitability from Indian LLP to outside India. So in order to avoid such kind of misuse, LLPs must be fair value. So all those who are working with the LLPs, if any one of you are dealing with receiving investment inside the LLP, that cannot happen at fair value, that cannot happen at the interest in the LLP equivalent to the book value. It must happen at a fair value, and it can happen at book value only if book value is a fair value. Okay, Let's move ahead now. Transfer of capital contribution or profit of share of LLP we have already discussed. I think it's the last point now that we need to discuss. It's on non-applicability of pricing guidelines. That is, if you are receiving an investment on a non-repatriable basis, that is, you only get the money in India, but you are never allowed to take back money, to any other nation. Then in that case, perfectly fine. We don't want to apply any pricing guideline. Let you come here, let your money remain here. Whatever you want to do here, let it remain in India. We have no issues with that. So if you are receiving an investment on a non-repatriable basis, then these pricing guidelines are not applicable. These pricing guidelines are applicable only when you receive money on a repatriable basis. That is by way of you investing in India, and then you are ultimately taking back money by way of either transfer or by way of dividend or share of profit. So let's go ahead and now let's discuss on investments from India, that is overseas direct investment. Now I have only 6 critical points to discuss, and I'll be quick while discussing these issues because we have already 45 minutes into the presentation, and I'll take not more than maybe 5 or 10 minutes before I go into discussion of a case study. So I would say we have, let's say, next 30 minutes or so, minimum 30 minutes I need to cover ODI guidance and then the case study before I open up the floor for any debate, discussion or question answer session. Overseas investments or financial commitment in joint ventures and wholly owned subsidiaries have been recognized as important avenues for promoting global business by Indian entrepreneurs. So joint ventures are perceived as a medium of economic and business cooperation between India and other countries. Transfer of technology, skill development, sharing of research and development. From a market perspective, access to wider global market, promotion of brand image, generation of employment, and utilization of raw materials available in India and in the host country are other significant benefits which are actually arising out of such overseas direct investments, or obviously out of overseas financial commitment. They are also important drivers for foreign trade through increased exports of plant and machinery and goods and services from India, because you have a marketing subsidiary in other countries, and then these goods in India which are produced gets exported to your subsidiary in other nations, and then that's where the trade happens. So they are absolutely important in terms of increasing the exports of plant and machinery, goods and services from India, and also to source of foreign exchange earnings, because the more you export, the more foreign exchange you get. In order to get those foreign exchanges, you need to invest in foreign exchanges, and when you invest in foreign exchanges, is nothing but the overseas direct investment that you are speaking here. So you can earn by way of foreign exchange, dividend earnings, royalty earnings, technical know-how, fees, and other entitlements when you do such investments or when you have such financial commitments. In keeping with the spirit of liberalization, obviously, which has become the hallmark of our economic policy, the foreign exchange regulations in particular, the Reserve Bank has progressively relaxed the rules and simplified the procedure for both current account as well as capital account transactions. See, Section 6 of FEMA provides powers to RBI to specify in consultation with Government of India uh, to identify those classes of permissible capital account transactions and limit limit the number of transactions or the amount of amount that is admissible under each of these particular transactions. Section 6(3) of FEMA provides powers to Reserve Bank of India to prohibit, restrict, or regulate various transactions referred to in sub-clauses of that subsection by making these regulations. So what RBI does is RBI regulate the acquisition and transfer of foreign security by a person resident in India, that is investment by resident by Indian entities in overseas joint ventures or wholly owned subsidiaries. So typical case that we recently handled was I was working with one of the major Indian entrepreneur group, and that company recently acquired, not very recently, almost, we have traveled now more than 1 year now. We acquired one of the major brands, the 100-year existing company in Italy. So when that acquisition happened, obviously we fall into the rules and regulations of overseas direct investment. The first step that we need to analyze is whether we are falling under automatic route or under approval route. Automatic route means there are certain areas, certain industries where you can make investment, that is, you can transfer money without actually taking approval from the government. And there are certain other areas where the approval from the government is necessary. So obviously, I must put on record, the AD banker has helped us a lot, while transferring this money into the curator's account, into administrator's account, into the owners of the foreign company's accounts. And then AD banker has also guided us in terms of filling up those forms and helping us understand these ODI regulations and exactly where are we falling. While doing so, there were a lot many regulations and lot many working paper and documentation that was necessary. The purpose needs to be mentioned, the source needs to be mentioned, the network needs to be mentioned, and lot many things the AD banker asked us. And only upon his comfort that okay, fine, we are not basically taking this money out of India by way of embezzlement of funds, he allowed us to transfer those funds. Now, despite these rules and regulations, sometimes I wonder how these fraudulent people, were able to move away 1,000 crores worth of the properties from India. I was basically referring to some of the recent frauds that we have seen from year 2000 onwards. So if I wanted to acquire company, okay, in Italy, if I had to undergo so much of robust regulations and rules, how these people, they don't come within the ambit of these rule equation. And even if they do so, I believe that unless there is an internal perpetrator that is, having when these perpetrators are in hand and gloves with the bankers, I think the scam is impossible. Having said that, as a valuer, you need to work in tandem with the promoter who is acquiring the company, and also with the technical experts locally in other nation, and also with the AD banker, because AD banker would also need to put on record the valuation report. He definitely seeks the valuation report, and you also, while filing the online compliances, have to upload the valuation report when you are making foreign currency investments, whether you are making that investments as a direct investment or in GDRs or let's say FCCBs, and obviously I'll speak about it. So there are certain definitions which I believe you must be aware of. One of the definition I would like you to know is of direct investment outside India. When we say direct investment outside India, what I mean is it's an investment by way of contribution to the capital or subscription of MOA of a foreign entity by way of purchase of existing share of a foreign entity, either by market purchase or by private placement or through stock exchange, but does not include the portfolio investment. So if you are a portfolio investment company, then obviously we are not calling your investment as a direct investment outside India, because you are more like a VC created in India and who is making investment outside India. I'm not referring to that kind of investment as a direct investment outside India. I'm speaking about those manufacturing or service companies who are establishing their own subsidiaries or who are acquiring the existing stake from some of the existing companies outside India. The second thing that I believe you must know is the concept of financial commitment. Financial commitment means the amount of direct investment by way of contribution to equity, loan, and 100% of the amount of guarantees and 50% of the performance guarantees issued by an Indian party to or on behalf of its counterparts in overseas territory, that is overseas joint venture or overseas wholly owned subsidiary. And let me give you the practical scenario where we get exposed to such kind of uh, overseas direct investments. So I'll quote once again example of the Italian company that we acquired, and there were some of the turnkey projects that this Italian company is doing. Now, Italian company applied for the tender, and because it was a newly incorporated company, I mean it was newly acquired company in Italy. Obviously, the credit rating was not available because there was a change of ownership. And when we acquired the company in Italy, what we did was we did not acquire the equity share capital, rather it was a business acquisition that we did. So we created a business acquisition report. We established a new subsidiary in Italy. We brought in the money from India to new subsidiary in Italy, and that new subsidiary in Italy acquired the business of the existing company in Italy. We did that in order to avoid any kind of future contingent liabilities that may turn out unnecessary to us. We did that so that we did not have any kind of hidden liabilities to take on our head, which means there could be potential tax liability, there could be potential penalties and non-compliance liabilities that may accrue onto our head if at all we go ahead and acquire the equity share capital of those companies. So what we did instead of acquiring equity share capital of these different Italian companies, we established a new company. We brought in money in the Italy, and then that's how we acquired business of Switzerland, business of Germany, business of Italy, business of some other parts of the European nations. While we do so, the share purchase agreement said that okay, the X amount will come now, then Y amount will come after 7 days, Z amount will come after 15 days. So it was a kind of commitment to invest in equity. That what we need to disclose while we are following up and then fulfilling all these RBI compliances. Similarly, when this newly incorporated company participated in the turnkey projects of the Italian government, of the German government, etc., these governments asked for the performance guarantee. These governments asked for the financial guarantees, right, for the execution purposes. And the financial guarantees was primarily asked because they have given 10% advance of the total project value. Now, in doing so, they realized that it's a new company with a new management, and this company may not have the running resources, because it was kind of the initial project, and that's where they said that we need the corporate guarantee of your parent company in India, and that's where we extended the corporate guarantee from India. While doing so, again the RBI said that it falls within the framework of ODI guidelines, and then it also fall under the compliance under Companies Act, because you cannot give corporate guarantees beyond a particular level, and Companies Act basically brings out that threshold beautifully. So we need to simultaneously comply the Companies Act as well as the overseas direct investment rules issued by RBI, while not only transferring money for the purpose of acquiring the equity shares of a newly formed subsidiary, but also when we were extending the corporate guarantees in it. I would also like you to know the concept of GDR, which are global depository receipts. It means security issued by a bank or depository outside India against underlying rupee shares of a company incorporated in India. And one of the example could be of Infosys. There are many Indian companies which have listed shares in India, but they have also issued GDRs in order to raise. It's basically security issued by a bank or depository outside India against underlying rupee shares of a company incorporated in India. So the bank issues those GDRs, and what basically collateral that you have is shares of a company in India. Typically, it happens only in case of a listed shares and not in case of unlisted shares. The meaning of host country is also important. Host country means a country in which foreign entity receiving the direct investment from Indian party is registered or incorporated. So when I say I invested a company in Italy, basically Italy is a host country. By the way, while doing so, RBI also asked us to give our records of the net worth, which means the net worth of the company, net worth of its subsidiaries, net worth as a group at a consolidated level, etc., etc. Possibly because it wanted to identify whether the group is solvent or not. By the way, section 2 of Companies Act also defines the meaning of net worth, and these guidelines also define the meaning of net worth. Okay, so the meaning of net worth is not exactly same in both the laws. Okay, in that sense, I would say if at all anyone is asking you to issue a certificate, often these bankers say that give us the net worth certificate. Then you have to go back and ask under which rule you need this certificate. I have seen many chartered accountants just issuing the net worth certificate saying that I hereby certify that the net worth of the company is this. Now don't limit yourself with this language. You need to travel one more mile by saying that the net worth under this section of this act is this. Because if you just give a blanket certification, the reader at the top you are writing that to whomsoever, which means that you are saying that a banker wants to read this certificate in RBI guidance, a tax authority wants to read this certificate in tax parlance, and the auditor wants to read this certificate from the Companies Act parlance, can do so, can definitely go ahead and read it, and each of them ultimately end to believe that they actually are looking at a net worth in line with the rules and regulations that they are following. So obviously, please don't limit your language when you're issuing certificates by way of not writing the section number or para number. I strongly recommend, I personally believe that the certificates that I have seen were incomplete, in a sense that they never made reference to these rules and regulations. They just given a blanket reference saying the net worth is this much. So please avoid giving these blanket certifications. Okay, now let's speak about general permission. So general permission has been granted to persons resident in India for purchase or acquisition of securities. If you are transferring these funds out of your RFC account, or maybe if you are getting it as a bonus shares on existing holding, or maybe when you are not permanently resident in India, and when you have your foreign currency resources outside India and you are purchasing these shares out of your foreign currency resources, then there is a general permission. You don't need to worry about it. You just go ahead and then you can make the investments without looking at any rule. However, there are certain other rules which you need to follow if you are doing investment by way of your resources from India. So if you are buying, let's say, shares of company in USA by using your resources in India, then you need to check whether your investment falls under automatic route or falls under approval route. Now, there are certain 5-6 different kinds of investments that fall under the automatic route, which includes 100% amount of equity shares or a compulsorily convertible preference shares. That is, if you are going to invest in your wholly owned subsidiaries, then perfectly fine, it's automatic route. If you are going to invest in 100% of the amount of preference shares, perfectly fine. If you are going to grant a loan to your subsidiary, perfectly fine. If you are going to give guarantee, which is basically financial guarantee, okay, then again, it's perfectly fine. You can go ahead and do that. It falls under the automatic route. By the way, for the performance guarantee, the 50% is the amount of performance guarantee that can be provided. It's not the 100%. So there is certain limit, okay, when we are looking at the performance guarantees by Indian company to its counterparts in foreign countries. And how should you perform the valuation? So now let me come to that part of it, obviously, the pricing part of it. But generically, I would say that you need to carry valuations as per the recommendations of the investment banker if the shares are not listed on any recognized stock exchange, or on the basis of current market capitalization of the foreign company arrived at on the basis of monthly average price on any stock exchange, etc., etc. You can read through those rules, and it's similar to what the SEBI guidelines that we have. You average it out. You try to analyze whether it was a tradable security or not. You try to observe the market, is it active or inactive. You observe those things, and then finally you pick up those data pointers out of the current market capitalizations of the listed company in USA, and that's how you perform the valuation of listed company outside India. So some of the ODI pricing guidelines that I would like to discuss, there are 5 points that I have mentioned. One is when we are looking at the partial or full acquisition and the amount transferred is of more than $5 million, or maybe you are making an investment up to 5 million, so is equal to or less than 5 million. Third, we are going to discuss on the swap of shares. Fourth, what if you are investing in unlisted shares, and what if you are investing in the listed share. Fourth and fifth point, I have already discussed that, but I'll be very quick while I run through this slide so that we get some time to discuss on a case study. I would like to discuss minimum 15-20 minutes on a case study, so that it gives you the better perspective of how the way numbers are utilized, or at least the qualitative aspect of performing the valuation. So in case of a partial or full acquisition of existing foreign company where the investment is more than 5 million, then the valuation of shares must be made by the category 1 merchant banker registered with SEBI, or if you also get, let's say, the valuation report by investment banker or merchant banker outside India registered with the appropriate regulatory authority, then perfectly fine. And in all other cases, that is, if the investment is equal to 5 million or it is less than 5 million, then a chartered accountant or a certified public accountant, that is CPA, can definitely go ahead and undersign this particular valuation report. Now, in cases where the investment by way of swap option is happening, that is, uh, I'm investing in your company's shares. That is, I'm investing in, let's say, US based companies shares. So I'm going to get US companies equity shares, but I'll say that I don't want to pay you in terms of cash. I'll issue my company shares. So it's a swap session happens. So in such cases, irrespective of the amount, the valuation of shares will have to be made by category 1 merchant banker, okay, who is registered with the CB, or obviously by a merchant banker registered outside India with the appropriate authority in the host country. Okay, so you can't just say that, okay, I am getting certificate from one of the big four in USA while you are doing investment in Switzerland. No, it is not allowed. Either you give business to Indian merchant banker, or I mean category 1 merchant banker, or let the Swiss merchant banker do that job, and then you accept that if it is acceptable to you, right? So you can't just bring in any third party valuer for performing valuation in the host country. He needs to be a valuer, appropriate valuer, like a merchant banker or registered valuer from that country, who has right to perform those valuations. Or better, you give that particular valuation engagement to category 1 merchant bankers in India. Right. So I think I tried my level best to cover majority of these theoretical issues on FDI and ODI, and now I'll prefer to go ahead and discuss the case study. Before I do so, a quick definition of a fair value as we have in defined under Ind AS. If you have observed, in none of the 6 pointers that you see on the screen, we see the wording arm's length price. On the other hand, if you look at the FEMA rules and regulation or the RBI rules and regulation, they have repetitively used the word arm's length pricing. Okay, so it looks to me that when IASB, FASB, IBSC, VSB in India, all of us has moved from the old definition of the fair value, which basically said, कंधे की दूरी का transaction, बराबर है ना, यानी the arm's length price. तो वो वाला पार्ट अब चला गया है, but somehow still RBI or FEMA have not elevated or moved up by reference to the arm's length transaction to orderly transaction. Okay, if you go into the definition of orderly transaction, it also makes reference to those independent market participants who are performing their transactions at the arm's length price. So somewhere inside the definition of fair value and its elements, it definitely makes reference to arm's length price. But while making reference to arm's length price, we forget to make reference to an exit price. So that's why rather ISB and FASB changed its definition after the financial crisis in 2007, and those amendments were adopted in order to bring out this new definition of fair value. So I would say that while you writing your report and defining the terms, or when you say that I am understanding the fair value of an equity share of that particular instrument, I would suggest you to make reference to definition of fair value as given here on the screen, and because it is acceptable as per IFRS, it is acceptable as per Ind AS, it is acceptable as per all international law as referred by the FEMA itself or as referred by the RBI guideline itself. However, while RBI makes the language in asking you to get the fair valuation report, it somewhere forgets to use the language from the new definition and continues to use the words from the old definition such as arm's length price. But that's not confusing. It actually means one and the same, that you need to get the fair value, right? And I think the newer definition is a better definition, as it's a larger set. It also captures the concept of exit price thoroughly, and it is very well appreciated and adopted across the plethora of compliances in various countries. Last but not the least, while you perform the valuation, there are typical inputs that are necessary. These inputs can be identical and from the active market, which case we say that they are the best inputs, and you must always maximize the use of such best inputs to whom we typically refer as level 1 inputs. If you don't have such kind of good inputs, it's okay, you can rely on second level of good input, that is level 2 input, which may not be identical but which are similar. These are observable. And last but not the least, if you are dealing with, let's say, unlisted companies, you may not have directly observable data. Then you need to go back, look back, and analyze the company, and you have to use the company specific inputs which are not really observable from the market. So then you use the level 3 inputs on observable inputs. When you are doing valuation, if you are using the level 1 input, the fairness of the value is fairer. On the other hand, when you are using the level 3 input, still you call the conclusion as a fair value. But I still believe that as the ad of fair and lovely goes, and you can see, the different colors or the shades of that fairness, I believe the level 3 inputs results in darker fair value. Not the darkest fair value, but slightly darker fair value than what fair value you can get by using the level 1 input. Still, all the values are fair values, they are not unfair values. So until you are using level 1, level 2, or level 3 inputs, it's perfectly fine. The conclusion that you are getting by using correct approach and methodology are definitely fair values. Let's move ahead now into the case study. While I do the case study and I take you inside with the numbers, some of the issues that you must know while you are taking up the engagement of valuation is, what is the meaning of fair value and how should you perform? What is the process of performing that fair value? Basically, when you are dealing with the income approach, you need to deal with the cash flows and you need to deal with the discount rate. When I typically deal with the cash flows, I consider what is the base year, what is the growth rate, what are the margins, what is the terminal value. While I deal with the discount rate, obviously I need to analyze the risk rate. I'm looking at the equity risk premium. I look at the beta. Sometimes I also look at the alpha, which means what is a company specific risk premium. And then obviously the tax rate, which is a effective tax rate, because some of the companies may be loss making now and of which the losses can be carried forward in the future, and then the effective tax rate could be different. Now some of the companies may create subsidiaries which are new manufacturing companies and maybe take benefit of section 115 BAB, if I'm not wrong, which allows you to pay taxes at a lower rate by establishing new manufacturing plant and calling yourself to be a startup company, and likewise. So the effective tax rate at a consolidated level needs to be analyzed. Finally, you need to look at the stake that you are acquiring, whether you are acquiring the stake of a listed company which has liquidity in the market, which means the shares that you have acquired are marketable, or you are acquiring the stake of a company which is illiquid, that is, it's unlisted company. You are acquiring more than 50%, which represent the controlling stake, in which case the control premium becomes applicable. Or if you are acquiring, let's say, less than 20%, where you don't have even a significant influence, and in that case, then you need to rather give a discount for the lack of control. While you deal with the fair value under FEMA and RBI, some simultaneous compliances may also necessary under 11U, 11UA, etc. under the Income Tax Act. And in that case, I would recommend you to understand, at least theoretically, the difference between the word fair value and fair market value. Because of the paucity of time, as I written on the screen, I may not be able to give you a detailed commentary on this. But what I can do is, I have given you a direction. Go back and check kind of the words that I've used. The word used in Ind AS, IFRS, and in International Valuation Standard or ICI Valuation Standard is a fair value. The word used in income tax is the fair market value. So there is a difference. When we say FMV under income tax, again, you are allowed to use the NAV approach, or there is a typical rule book under the Income Tax Act. On the other hand side, for the FEMA or for Ind AS, IFRS, and ODI compliances or FDI compliances, you are allowed to pass your judgment. There is no very explicit rule book. Or if you are falling within the four corners of those rules, you are perfectly fine. The value can be a fair value. Finally, last but not the least, when you are doing valuations and when we are discussing in days where the COVID-19 has become a reality, we have all undergone the scenarios where it has heavily impacted the businesses, and it's not like the impact was only for a reasonable period. It was long. It was uh, it has gone deep into the change in the dynamics of the business, and obviously how the way you want to absorb such kinds of pandemic risk going forward also becomes a question. Will you perform sensitivity analysis for this, or would you like to capture these kinds of uncertainties in the cash flows or discount rate, is what you need to ask yourself and answer and articulate in the report that you are producing. If I were you, and what we do at my companies, we heavily use the Monte Carlo simulation, and that's where we build up 1 lakh scenarios of the valuation, or at least 20,000 scenarios of the derivative valuation, and then that's how we say that, okay, fine, this is what the fair value at 80% confidence level or 90% confidence level. And that's how we use heavily the statistical models and perform the Monte Carlo simulations in our conclusions. Uh, let's move ahead. Let's move ahead into now the valuation approaches. These three approaches are perfectly fine and they are well acceptable at international level as well as at ICI level. The market approach, where you can basically identify the comparable transaction of an identical security or a comparable transaction of a comparable security, or what you can do is, if there is a comparable company which has recently received the investment, maybe let's say the revenue multiple or EBITDA multiple can be used, that can be applied to your revenue or EBITDA in order to get the overall enterprise value of your company. And then from that enterprise value, you can go down to your equity value and then the value of the security that you are issuing. Income approach is nothing but dealing with the cash flows. We have typically the dividend discount model by the Gordon, which we use in case the company is a dividend paying company. If the company is not a dividend paying company, obviously, or partially dividend paying company, or the erratically or volatilely dividend paying company, we prefer not to use the dividend paying model. We prefer to use the income approach, where the reinvestment amount gets captured in the free cash flow, and those free cash flows, either for the firm or free cash flows for the equity shareholders, are basically discounted by using the appropriate the discount rates. And finally, we also heavily use the net asset method. We have been using it in case of transfers of intangible asset. We have been using it in case of those companies which are driven more by the asset and not by the technology, which are using this methodology for those subsidiaries which are capital intensive subsidiaries, and or maybe for those companies which are represented not by a land bank, because typically the book value of the land bank and the market value of land bank could be fundamentally different, right? So in that sense, first step is to identify which approach is suitable for a company that you are valuing or the shares that you are valuing, and the second stage is to identify the method that is suitable inside a suitable approach that you have previously identified. Let's now move ahead and let's discuss on the valuation of unlisted entities. Minimum 4 issues, okay, that you must address while you are doing the valuation of unlisted entity. According to me, don't just follow the way VC value these companies. Don't get hammered or unnecessarily influenced by a web series like Shark Tank. Okay, you don't do the valuation by sitting on a chair, by sitting in Agnipath mode and saying that, okay, fine, I believe the valuation of your company is 5 rupees per share or 15 rupees per share. That's not how it happens. Okay, that's definitely not it happens. Please understand that I have seen many people around me who are getting attracted with the glamour of these web series, and then tend to call themselves either as a shark or someone who is getting eaten by the shark. Trust me, as a valuer, you must be absolutely unbiased. It's good for you to go ahead and watch the Shark Tank, but both of us will agree, if you are a true valuer, that okay, some of the prices that these people have paid, okay, in that particular web series, they were insane, and they were not justifiable. They were definitely not justifiable. And I can prove you, for example, people paid so much amount when the Zomato IPO came. People paid so much amount for, let's say, when the Paytm IPO came. Okay, even that time, Arpit Bhai was there. When we conducted one of the seminar, I explicitly mentioned that that particular stock, I think it was of Zomato, which was traded at 140 or some 120 plus. I explicitly mentioned that time that according to me, it looks to me overvalued. And then everyone was jumping out on the frying pan and they were investing. And today, you look at the valuation. Look at the value of, let's say, the Nika, where initially they all followed the VC approach, like a multiple of revenue, etc., etc. And today that share is, according to me, I think it is definitely 30% less than what price it ultimately faced. So it would move from some 1,800 to 2,100, and I think it is below 1,800 now. So don't just go and sit on a boat of VC valuation where you say that valuation is an easy exercise and you attach a particular multiple to your revenue, or you attach a particular multiple to your EBITDA without looking at it in context. Because other company got a multiple doesn't necessarily mean that you should get the same multiple, and that's what the valuation standards say. Some calibration is necessary. So the first step is to shred away with the VCA approach and then be unbiased, be objective in analyzing what is the right approach to value your company, what is the right method to value your company. If you are adopting the income approach, obviously you can go ahead and decipher the beta, which represents the market specific risk. Please note that the beta never captures the entity specific risk, and that's why we might need alpha to bring it. Now for some of you, this particular commentary could be too technical, but let it be, it's perfectly fine. Okay, just make a note of it, and whenever you are practically getting exposed to these calculations, ask relevant questions from these notes and ask whether the beta calculated is truly representative of your company, or should you use the cash adjusted beta, whether the beta is correctly identified, whether it is properly adjusted for the capital structure of the company, because both of the companies, let's say your company and your peer company, may be working in the same sector, in the at the same village or at the same city in the same country. Let's say both of you are analyzing two companies in USA, and your choice for the overseas direct investment, either to invest in A Inc. or invest in B Inc. Let's say they both have the same amount of capital, but the capital structure is different. Let's assume that they have the same income level, same profitability level, but the capital structure is different. And when the capital structure is different, the beta will be different. Though they represent the same market risk, obviously because of the change in the capital structure, the beta of the company which is highly levered will be higher than the beta of the company which is less levered. Now the beta of the company which is high levered ultimately results in the higher discount rate, and then the higher discount rate results in the lower valuation. So likewise, you can, obviously I'll be sharing these slides with all of you. Subsequently you can go through it in detail, and then you can get many critical points from the valuation side. Now some of the key questions that I ask when I'm dealing with my client, okay, in terms of the valuation model, let's say that what we create in software, or in, let's say, Microsoft Excel, we have to ask question on estimating the revenue, we have to ask question on estimating the EBITDA, we have to ask question on how the way WACC is calculated, or when we are doing the WACC, should we use the current debt ratio or should we use the expected the equity debt ratio, because today the company might be highly geared, and let's say the company has plans to pay off these debts going forward and don't go for the replacement of debt. So let's say today the debt equity ratio could be 70% debt, 30% equity, and tomorrow, let's say down the line 3 years, that ratio will be down by let's say down from 70% to, let's say, 30%. Then obviously it requires a cognizance in my valuation model, because if I don't do it and if I assume that the debt equity ratio remains same at 70%, I'll be discounting these cash flows at a higher level. And then if you do so for the ODI, it's good, because you'll be paying less amount, as you'll be discounting at a higher rate, you'll be getting the lower fair value. But on the other hand side, for the FDI, you are performing the similar valuation, Indian government, because of your calculation, will end up getting lower money, because you assume that your company will continue to have the similar debt structure going forward. So don't do that. Read these questions carefully going forward. The decision matrix is important. Whether you are going to calculate the valuation by using the free cash flows to enterprise or free cash flows to equity shareholders, what could be the growth period? Don't just assume that okay, the growth rate that you capture in the terminal value will be like 17% or 18%. No company, mark my words, okay, no company in the world has seen only the northeast curve of the growth. It is always the high growth stage, mid growth stage, maybe a stability, and then decline if the R&D doesn't happen. So if you want to give the higher growth rate in the terminal value, perfectly fine. At the discount rate calculation, you give the higher growth rate in the terminal value. But on the same hand side, you need to have higher reinvestment in the R&D in the terminal cash flows. So if obviously the valuation is a composition of two elements. One is the cash flow, second is the discount rate. If you want to use the lower discount rate, ensure that you're also calibrating the cash flows, because without those heavy R&D costs, your curve cannot always be northeast. So these are some logical areas that you must look into before you go out and conclude on your discount rates or on your numbers. For any discount rate, when we look at when we analyze what kind of discount rate should be used, we look at the risk-free rate, we look at the beta, we look at the equity risk premium, and as you can see on the screen, what kind of factors that influence the decision making. So in case of, let's say, domestic company, should I use the government bond of 10 years or 30 years? That becomes a decision decision area when I'm identifying the risk factor. Now you look at the government bonds over last couple of years. I would see the government bond in India was reasonably okay for last couple of years, okay, in terms of the volatility. But if you go back and check the US government bond, okay, in nominal terms, you would see today employees in USA are losing in real terms. What do I mean is the inflation rate in the USA is higher than the risk-free rate what they are getting. It was not so few months back, but in today's terms, if anyone who is employed in USA, basically the inflation is higher. On the other hand, in India at least, you know, we are not at this stage where we are losing in the real terms. Yes, is there inflation in India? Answer is yes. So for FDI, obviously, you know, you have to choose whether the cash flows are present in the nominal terms or in the real terms. Now this particular inflation that we are seeing in India, let's say more than 8% or 11% in some of the commodities, you can go ahead and capture such kind of inflation when you are identifying the price. So the growth of the revenue need to be analyzed in terms of the price into volume. So either you identify your cash flows on a nominal basis, and then you should also have your discount rate on a nominal basis, which means you capture the inflation in the cash flows, then you must also capture that inflation in the discount rate. On the other hand, if you are calculating the cash flows in real terms, you can't just have the nominal discount rate, because you know you will end up having the higher discount rate and you know the real cash flows, which is so illogical. So the real cash flows demand real discount rate, nominal cash flows demand nominal discount rate. I think I'm just short of time, but I'll quickly try to run through the Aramco case study. I'll be very quick, okay? Let's quickly read on the background. Aramco made its debut on Saudi Stock Exchange in December after raising 29.4 billion through IPO by selling 1.725% stake. It overtook Microsoft and Apple to become the most valuable listed company at 1.88 trillion. Aramco overseas listing still on cart, which means Aramco is not yet listed on New York Stock Exchange or London Stock Exchange. It is only listed on Saudi Stock Exchange as of this stage. I have done 3 valuation exercises, and by the way, you are going to see the detailed valuation in next 5 to 10 minutes. First, I'll show you the relative valuation. Then I will show you the income-based valuation by using the dividend distribution model, and I'll also show you by using the free cash flow model. So while performing the valuation, what kind of data that we collected? We analyzed 373 entities worldwide working in oil and gas. Then we identified the name of exchange on which these companies were listed. Out of these 373 different entities, we had 57 public entities, 286 private entities, and 30 oil assets. And then data related to public companies were available. That's why we finally said that, okay, we are going to identify these 9 data points which are financial data points and 4 non-financial data points, that 13 data points that we must analyze in order to identify the sample that is truly comparable for the relative valuation. So from the financial data points, we analyze the market capitalization, total debt, total cash and short-term liquid investments, total revenue, EBITDA, EBIT, net income, interest expense and equity. And from the non-financial data points, we analyze the total proven oil reserves, probable oil reserves, oil equivalent production, and closing reserves. While we did so, we analyzed it over 36 months. So basically there were 27 data points of EBITDA, revenue, and oil production, and there were 2 additional data points that was of credit rating in foreign currency and credit rating in local currency. So out of these 373 data of 373 entities, we finally said that, okay, fine, out for 57 public entities, we have total 9 financial data points, 4 non-financial data points, 27 historical data points, and 2 data points for each company, which means we had 57 into 9 plus 4 plus 27 plus 2, that is 57 into 42 data points for our analysis, that is 2,394 data points in order to evaluate which companies were truly comparable for the relative multiple. Then we processed 14 values out of those 42 data points, and what we analyzed is enterprise value of these companies, invested capital of these companies, PE ratio, PBV, enterprise to sales ratio, then EV to EBITDA multiple, EV to invested capital multiple, EV to proven results multiple, EV to oil produced multiple, return on equity, return on invested capital, operating margin, debt equity proportion, and debt equity proportion with respect to market capitalization. Now, why we did that? We did that because you can't just pick up a company and say that it is comparable company. For example, I have seen some of people, who are working for FDI compliance. They were doing the valuation of one of the software company in India, and what they did, they just pick up Infosys, they pick up the Wipro, and they say that the multiple of Infosys is X, the multiple of Wipro is X, and that's why the average multiple of Infosys and Wipro needs to be applied to the company that we are valuing. Now, the company that you are valuing, is it a product company or service company? You can't just generalize the technology companies. If you are valuing the antivirus company, possibly you should better use the multiple of the Quick Hill. How can you use the multiple of, let's say, Infosys or Wipro, right? Now, these listed companies are conglomerate, so you cannot just say that any software company can be valued on the basis of, let's say, some of the known names of listed Indian technology companies, right? So in order to filter and screen through which are comparable companies, that's what we did. We finally said that these are the 26 listed companies which are comparable, and we said these are the 9 key ratio numbers that we need to analyze. So from the overall data points related to 373 entities, we finally identified only those 26 which are comparable companies, and then 9 key points out of those for those 26 companies were then analyzed. So 233 data points were analyzed like this. So these were the names of some of the companies that we analyzed on the left hand side column. Each of the column represents those 9 data points. Of each of these numbers, we identified the average, median, first quartile, and the third quartile, and then we compared it with the company that we are looking at, that is Aramco. So the conclusion that I draw here in the last slide, basically it's the same thing that you look here, and then these numbers were applied to Aramco's net income. So pricing metric is net income. So Aramco 2018, this is a net income. So if you apply this 11107 number to the P multiple of the first quartile, that is 7.92, as you can see here, 7.92. So 111,071 into 7.92 will give you the valuation of approximately 8 trillion, and likewise. Okay, so each of these multiples were identified on the basis of, like I said, 26 listed companies, and all these 9 on the basis of their median, first quartile, and third quartile were then applied to the key pointers of the Aramco in order to identify the valuation. So valuation on the basis of first quartile, valuation on the basis of median, and valuation on the basis of third quartile were then analyzed. Then I think this is better picture. Somehow this presentation was very clumsy and you cannot get a comparable view exactly how Aramco is valued as compared to its peers. So the next slide, as you can see, is the first quartile. The last is Aramco, as you can see here. Okay, I think when you use the invested capital, it looks to me that these both companies, let's say this EximMobile would be better placed. The book equity, if you do the valuation on a book equity basis, again Aramco and Royal Dutch or EximMobile, they are well comparable. But the moment you shift to the net income approach, which means the ability of Aramco could be better in terms of bringing the revenue or bringing the profitability to the company than the ability to bring the similar profitability by all these companies, it's getting reflected here, and that's why Aramco should have the better multiple. See, the net income, or let's say the EBITDA multiple, or let's say the proven reserves multiple, as you can see here, the Aramco is far better placed, and that's why it faced the overall value of I think some 1.88 trillion worth. So going ahead, this was on just a second, yeah, this was on the median basis. Again, the production rights for Aramco was limited to 40 years. We have observed the countries, we have observed the political risk, because there is still a monarchy, there is no democracy, it's a autocracy that we see in the government. And now this is the comparison, as you can see, on the basis of the third quartile. Now, to me, first quartile and third quartile could be outliers, but I still wanted to show you how it looks in terms of the comparable companies. Obviously, we ended up using the median, To me, the value of Aramco on the basis of book equity multiple and revenue multiple is similar to value of ExxonMobil and Royal Dutch. But like I said, the value when we look at the net income or EBITDA is far better and far greater for obvious reasons, because the efficiency that it has in terms of the production cost is getting reflected in the value. Because Aramco's extraction cost is $20 per barrel as compared to every other its competitors, the extraction price of $40 to $45 per barrel. And that's why the Aramco must be valued differently than the way these coal companies are valued. And on this basis, we are getting somewhere valuation of 1.2 trillion here. Okay, now on the basis of the median, we are getting the valuation of somewhere around 1.5 million. So by the way, this was on the basis of net income, this was on the basis of EBITDA, this is on the basis of production and proven reserves. I personally prefer to go ahead with the valuation of the production, and I'll tell you my reason. When I did the valuation, I said that the valuation is approximately 1.5 trillion, and I will prove you out in next 5 minutes before we conclude the session. We have given the discount for the control risk premium by way of analyzing or comparing Saudi Arabia as a country which has similar risk to Russia. And when we analyze the companies which are in Russia, they are having the valuation which is with a similar capacity. We could see they are having the discount of approximately 60% to 30% in different multiples. So what we did that we applied this discount to value the Aramco. This was a country discount that we have given, and on that basis we said the maximum value on multiple of reserve basis that we are getting is 1.9 trillion. And that's what happened in one of the first slide. As you can see, if you see the listing price, let me just show you. Just a second, let me go to the background. Yeah, you can see here the valuation was the 1.88 trillion. So it also proved one of our methodology that the listing was at 1.88 trillion. That was the valuation that the market gave it. But when we performed the valuation, it was coming to maximum value of 1.9 trillion, that on the basis of the reserves. Taking it ahead on the DCF based valuation, now I'm just skipping up. I'll just give you the final methodology that we have. By the way, this company agreed on a particular dividend. So what we did, we applied the dividend discount model. We identified the value of equity, and then we said that there could be a probability of regime change. And if the regime changes, the value will go down by 50%. So that particular risk has been captured in order to get the value of 1.5 trillion, as you see on the screen. So this was on the basis of the promised dividend model. And then we did the sensitivity analysis. Original scenario, regime change scenario 1, regime change scenario 2, that is the probability of regime change is 20%, 10% and 5%. The value still ranges between around 1.5 trillion. Then we did the valuation on the potential dividend. So previous valuation on the promised dividend, this model is on the potential dividend, and again we are getting the value around 1.4 trillion with the probability of regime change of 20%. If we do the sensitivity analysis on the basis of potential dividends, again with 20%, 10% and 5% regime change, again we are getting the value somewhere around 1.5 trillion. Though it is in the scenario 2, which is a very optimistic scenario, it is going to 1.6 trillion. Still the value looks at 1.5 trillion. And then we also apply the FCFE approach. Again we are getting the value of approximately 1.5 trillion. And basically that's where I conclude my discussion. All the methodologies that I have shown you, that is the relative approach, then which where we have identified 9 multiples: P multiple, EV multiple, etc., revenue multiple. All these are well accepted and within the framework of international valuation standard. On the income approach side, I have given you 3 models. One is on the promised dividend, second is on the potential dividend, and third is on the FCFE approach. All these are again very well accepted methodologies at the international valuation standard. So if you also perform similar valuation when you are performing valuation for FDI compliance or ODI compliance, you are very well secured from the ambit of professional negligence, if I have to say so. If you perform the way I perform the valuation, it will be very well accepted and very well appreciated by the authorities, by the client and the investor. So with this, at 12:53, I say thank you, and I open up, last whatever 7-8 minutes that we have for any question, answers, or deliberation. So how do we typically have this question answer session? Anyone is going to conduct Q&A, or whether you unmute yourself and ask? I'm not really aware of typical way of these discussions. Anyone from institute would like to come in?
अभी तक कोई क्वेश्चन नहीं है सर. पराग सर. पराग सर.
Yeah.
सर क्वेश्चन नहीं है एक भी.
हाँ
मिश्रा
बोलिए
बोलो सर. क्वेश्चन नहीं है
हाँ
सर.
बोलिए. यस यस बोलिए.
सब बोल रहा हूँ क्वेश्चन नहीं है एक भी सर.
क्वेश्चन अभी नहीं आया है. ओके अच्छा
नहीं
ठीक है. तो यहाँ पे तो चैट में मुझे दिखेगा नहीं ना कोई क्वेश्चन.
नहीं सर, जो भी रहेगा मैं दे दूंगा सर. अभी तक क्वेश्चन नहीं है एक भी.
क्वेश्चन
केतन
नहीं
सर.
आया.
हेलो विरल सर.
हाँ
सर कैमरा ऑन करें.
हाँ वीओटी करना है कि क्वेश्चंस के लिए वेट करना है?
सर क्वेश्चन तो है नहीं अभी तक.
तो
एक
2
भी
मिनट वेट करना है तो कर सकते हैं वेट, अदरवाइज वी कैन गो फॉर वीओटी.
चलेगा.
वैसे कितने पार्टिसिपेंट्स हैं अभी इस सेमिनार में?
सर अभी
76
66 लोग हैं.
ओके एक्सेलेंट गुड. विरल जी आप कहाँ से हैं?
मैं बॉम्बे से ही हूँ, विद्या विहार में ऑफिस है. आई एम इनटू फेमा ओनली एंड आई
अच्छा
वर्क विद सीएम मनोज शाह.
Oh, wonderful. Excellent. Would you like to share some of your experience, because you said that you are also dealing in FEMA? Until we get
Yeah,
the question.
so
Please go ahead.
practically just not just experience, but what difficulty we usually face is the timeline for which the valuation report is valid under FEMA sometimes, because when we get some valuation report and if there is a delay in filing, then there is no clarity under FEMA as to what is the ideal timeline that valuation is valid. So sometimes banks come up, it is more than 6 months old or it is more than 3 months old, then it is not valid. You have to obtain a fresh valuation report. So if you can throw some light on that.
Yeah, sure. See, there is no particular case law as far as the validity of valuation report under FEMA, but there are case laws under IBC cases where it said that if the valuation report is within 6 months, it can be very well considered for the insolvency cases. Okay. Now, we cannot draw an analogy from the insolvency cases to FEMA, because we believe that for FEMA, it's a going concern organization. And obviously, every month, every day, there needs to be a progressive, let's say foreign investor is coming in. And if he is coming in, obviously he's not looking at the return of 4% or 5%, which he can get also by investing in some of the risk-free assets. So at a valuation level, we say that the report can be valid forever, but the valuation is of a particular date. So if AD banker or a FEMA is asking for a valuation as of a particular date, then you only validate the valuation as of that date. So filing is more of an operational concept, and filing can be delayed, it's okay. But if the money has received at that particular date, or let's say within the time frame which is acceptable, let's say 15 days, 20 days from the valuation date, and even if the valuation is filed subsequently down the line, even 5 years, okay, it's still valid. So report date is different, the valuation date is different. If the valuation date and the investment dates, they coincide or they are closer to each other, it's perfectly fine. You can please articulate and build up your argument with the AD banker that I mean, obviously when you are paying off your scenario is more of a ODI scenario, and in that case, if it is later than 6 months, I think yes, the AD banker will ask.
I will come up with that also. One of our cases.
हाँ मिश्रा जी, एक ही मिनट, विरल जी का बात होने दीजिए, फिर मैंने चैट में दिख रहा है आपको, मैं उसका ये ले लूंगा, क्वेश्चन ले लूंगा. विरल जी सॉरी, प्लीज कंटिन्यू.
We can take the questions first. That's fine.
अरे नहीं, आप बात पूरी कीजिए. It's not professional to interrupt, so आप प्लीज बोलिए सर.
So one of the cases where we had faced is कि ODI का ही scenario था. There was ODI scenario only. Valuation report was as on the date of the transaction. So value was as on the date of transaction, but report was signed at a later date. So usually RBI has taken a view that you cannot have a report at a later date but even if value is of as of that particular date as on which the disinvestment has happened, so they have done compounding in that case.
See, I'll tell you, RBI says you tell us before you invest. In your case, you have invested and telling RBI. So RBI's problem is not with the value, it is about the behavior that they were not made aware of this investment fact, right? So I think that's the only operational issue. What you can do is, there are also some other provisions under FEMA, and I'm very sure that you must be very well aware of these. You go ahead, you plead, and you say that whatever is the penalty, we agree for that, and you pay for that, because it was more of a operational delay, and you had no intention to strategically delay this process by way of embezzlement of funds, right? Now there are, my second question, I'll tell you, if AD banker has allowed you to transfer these funds without informing to RBI or without getting this valuation report on the record, then it is also primary fault of the AD banker, because this is how the embezzlement happens. AD banker should never allow anybody to transfer funds without getting make investments. Transfer funds for operational level is okay if you are paying for your purchases, perfectly fine, but you are making investment in equity shares, and then if you are not producing those valuation reports, then it's a fault not only of the person who is making investment, but also more of the AD banker. And AD banker should primarily summon these, sorry, the RBI should primarily summon these AD bankers and ask them, how can you allow this transfer? Because such transfers are allowed, most of the embezzlement happened through such rules, because there is a hand and glove between the one who is transferring funds and the banker himself, right?
Correct. True. Yeah, thank you so much.
Okay, so now I will take up the question which I have in the chat box. In case of OD, AD banks ask for the valuation done on the basis of audited or unaudited financials. So how do we deal with the same? Is there any rule for the same? The AD bankers will write any email. What they know is there is an audit, and they call every chartered accountant as an auditor or a tax compliance heads, right? They don't understand that valuation is not has to do nothing in terms of the audited or unaudited balance sheet. Valuation has to be done on a prospective financial information on the basis of lot many things, and by and in compliance with the international valuation standard. So there are two scenarios that we discussed. Either you are doing the investment more than 5 million, or you are doing investment equal to 5 million or less than 5 million. If you are doing the investment more than 5 million, you have to get the certificate from the category 1 merchant banker. Now category 1 merchant banker will not say that on the basis of audited report the valuation is so much. You never say that on the basis of audited report. You said the fair value of the equity share of this company or of the instrument is so much. We never said on the basis of audited financials. As one of the document, obviously the audited financials will be used, and the prospective financial informations are always unaudited because they are futuristic, right? Now in the second case, if you are making investment of 5 million or less than 5 million, obviously a chartered accountant or cost accountant or registered valuer can do so. Again, in that case, the question of AD banker can be looked as a only theoretical question. Please give him a benefit of doubt that he is not aware of this particular profession, and you say, okay, fine sir, we will give you the valuation report. You build up the valuation report in line with the valuation standard and submit it. He will assume that it is as per audited financial statement also, and let him be happy with under his own assumption. But there is nothing like a valuation on the basis of audited financial statement. There is no legal concept of writing an opinion saying that my valuation is on the basis of audited financial. So I hope by the way, this was all of a practical answer. There is no rule to refer to answer this particular question. Okay, any other questions? If not, up to you, Viralji.
Yeah, so I think there are no other questions, so ask a vote of thanks. Thank you, Parag sir, for accepting the invitation of WRC of ICI and coming to this platform and giving your valuable inputs on the subject of valuation under FEMA. Nowadays, due to globalization, we have seen that India has been receiving off late since last so many years many foreign direct investments, and even Indian companies are making lots of investment abroad and marking their footprints in the global stage. Sir, you took us through both the foreign direct investment and overseas direct investment provisions. You tried to explain them the basics of both the provisions, and also took us through the detailed valuation guidelines or pricing guidelines which are applicable for FDI and ODI transactions. You also took us through the definition of fair value under Ind AS, and at the last, the case study which you took, which had the detailed and minute presentation of what all aspects need to be considered while doing a valuation, what all approaches need to be taken while doing a valuation, and a case study of Aramco, which you did, the exercise which you undertook, was an eye opener for us as to how actually a valuation needs to be looked upon and done. So thank you very much, sir, for your time and inputs. I think we all must have been, all the participants must have gained immense knowledge from this presentation. Thank you, sir.
Thank you, Viralji. Thank you so much. I could see a couple of questions floating, but I think, I can take up, off the ground. We are already crossed the time, and
Yes.
being Sunday, even I need to rush. My request is that, see, please understand that I was here even at the last minute of the invitation. So it's not like I'm avoiding any questions. I'm very sure that many of you would have many other questions. ICI has my contact details. I'll be more than happy to connect with all of you, maybe on LinkedIn or so. Pass on questions. If there are any queries which remain unanswered, I'll request WRC to pass it on to me. I'll respond them maybe via email, or you can write me personally or in LinkedIn or so. I'll be more than happy to respond. Plus, give me 24 hours to respond this, and enjoy, everyone. Have happy weekend, and I hope I could add some value on this one Sunday afternoon. Thank you so much.
Thank you very much.